Hi, we're Fanatic, a youth-run nonprofit that aims to educate the next generation of youth on crucial financial topics. Through chapters, media publications, and enriching events, we hope to provide accessible, informative financial literacy knowledge and raise awareness about financial illiteracy. Fanatics Talks is Fanatic's very own set of finance-related speaker event. Joining us today is David Winterley, Senior Vice President at Onyx Private Equity. Mr. Winterley, thank you so much for joining and being part of our event.
Yeah, thanks for having me. Glad to be here.
Awesome. So to start off, what is private equity?
Yeah, it's I guess that is where we'll start, right? Yeah, I think the easiest way to understand private equity is just to think about what it used to be called, which is the leveraged buyout industry, and that's essentially what it is. It's buying companies with leverage, and so for people who are not familiar with that term, it's essentially using debt. So what the way I describe PE to people who don't really know it is just that PE is just like residential real estate. So when you buy a home, buy an apartment, you're putting down some of your own money, and that's the equity essentially. And then you're borrowing money from another source. And in the case of private equity, you're buying it from a supplier of private debt. In residential real estate, you're borrowing it from a bank in the form of a mortgage. So you're using money that you put down, equity, money that you're borrowing, debt to buy a business.
Gotcha. So in all cases, will private equity firms take a controlling stake in a company, or is there certain circumstances where it's not a controlling stake?
Yeah, it's circumstantial, but it also is strategic. So as you can imagine, we talk about private equity as if it's a single thing, but there are many different flavors to it. So I work in a business where the preferred position is the control stake. And so we're taking, more than 50% of the equity, control the board. But there are certain circumstances where either there's, the check size is too large. There are multiple private equity firms that partner on the same asset. Some firms just have a strategy where they're intentionally taking minority positions because they don't want to be in the business of controlling the board, that they'll be in non-control positions. So I'd say, as a rule of thumb, PE does not necessarily mean control, but it often does.
Gotcha. I understand that private equity firms hold positions in private companies, but is there ever a case where a private equity firm will hold stocks in a public company?
Mm, it's a good question. I don't think that I think the short answer is no, because if you're branded a private equity firm, then you should make just private equity investments. There are firms that are more kind of comprehensive asset managers that have multiple different strategies. And one of their vehicles may be a private equity vehicle, and one other vehicle might be investing in public markets. But if you're principally a PE firm, you should be doing PE investments. I'll say the only exception to that is if you have a private asset that you then take public and retain some of that ownership, then it would inherently be a PE firm that has a stake in a public investment. But that wasn't the intention. When the purchase was made, it was a private company.
Gotcha. So from a first surface level perspective, private equity and venture capital seem to have a lot of similarities because they both involve pooled capital into private companies. What exactly is the difference between those two investment types?
Yeah, there are a lot of differences, but the way that I think about it is just about size and maturity of the business, where VC is often taking smaller bets in earlier stage companies, but taking many more bets. I'm not familiar enough with the industry to really know this firsthand, but one of my colleagues who worked in both venture capital and is now in private equity said that the VC strategy is a little bit more of kind of spray and pray. You're making, dozens, sometimes hundreds of bets, but one of those bets could turn out to be 100x return, where the private equity model is to make many fewer investments. So for us, our portfolio is 50 companies right now, but there's much more effort into determining whether that specific asset is the right one, and then taking a larger bet. But the return profile, if you're buying a more mature company, particularly where we're investing, a great outcome would be 8x or 10x your initial capital invested, where in VC, if that's one of your winners, that's probably not a high enough return to overcome a lot of the losses inherent in a VC portfolio.
Makes sense. Makes sense. Are private equity firms categorized by industry such as tech or food and beverages, similar to how venture capital firms are?
Sorry, can you repeat that? Just are PE firms categorized by the industries in which they invest?
Yeah.
Yes, I think that, just with any industry, there are many different ways to segment it. I think the primary way that PE firms are segmented is by size of the fund, and then the size of companies in which they make the investments. So I work at a firm that is intentionally in the lower middle market. We think of those businesses as 100 to 200 million in revenue when you first start. There are firms, regardless of fund size, that buy smaller companies in the lower market, or buy much bigger companies in a bulge bracket or up market.
Makes sense. In your experience working in private equity, what are the main factors that make a company an ideal candidate for a firm?
The biggest thing is that it aligns with the firm's strategies. So once again, we talk about private equity as if it's all the same thing. All the companies do the same thing. I think the business model is similar in such that, private equity firms are trying to make investments that then are more valuable after a period of time, right? They can return money to their shareholders. But the way that they generate those returns is vastly different. And so, we have a model at the firm where I work, where we pursue acquisitions, add-on acquisitions as the primary value creation strategy. And so it's a lot of consolidation of industries. It's, creating, we call them like M&A machines, acquisition machines, that then where there's a lot of integration. You could have a completely different private equity firm. Sycamore Partners is one that comes to mind, where they're buying distressed retail assets like Talbots or Staples or something like that. And their strategy is to strip out a lot of the costs, restructure the assets, but it's not primarily a top line growth story like it is for my firm. So I think, just to confirm, the answer here was the best target for a private equity firm is one that it most closely aligns with its value creation strategy.
Gotcha. So in your specific circumstance, with a strategy that focuses more on mergers and acquisitions, is there something that you look in terms of like the founder of the company or the characteristics of the company when like getting involved with that company?
Yes.
And can you mention?
Yes is the short answer. I mean, there are, as you can imagine, it's multidimensional, right? I mean, it first has to be, if you just think about core strategy of where to play and how to win, right? So they are in markets that we think are ripe for consolidation, that are either stable or growing, and then they have either a defensible strategic position in that market or have a path to develop that position. Then you can talk about, kind of nuances of each business, why something might be more or less attractive of each management team, but you're always starting with the market and the future and, the fragmentation, and then go from there.
Gotcha. So you mentioned that a lot of private equities firms invest in financially distressed companies. What are the services that most private equity firms provide to these companies that help them get back on track?
So once again, that depends on the strategy of the firm, right? And that's, to be clear, that's not the firm that I work in. We're not intentionally investing in distressed assets. So I can't speak from firsthand experience, but because we're more focused on taking something that's good and supporting that management team or supplementing that management team to make it great. But if it's a distressed company in a good end market, then it's about just working on that asset. And so there's obviously a lot of due diligence that goes in before an investment is made. So just uncovering, whether it's something about the team or the strategy or the technology, there's a fundamental flaw in that business if it's distressed, but in a good market. And then so the services that you would provide either from the full-time employees at the fund level, like myself, or consulting firms that someone like myself might support and manage, would depend on the situation that business is in. So.
Makes sense. Can you elaborate on some difficulties you have experienced when working with companies?
Yeah, I mean, beyond the obvious, which is, you're working in a business and there are hardworking executives and the people at the private equity firm are doing their best. If it's an end market where just something changes, that's frankly out of everyone's control, that's a really hard situation. You think about, what's happening today with, COVID post-pandemic economic situation where, freight costs are quadrupling. They're maybe, don't hold me to these numbers, but doing something like going from $5,000 a crate to $20,000 a crate. Like in many businesses, that 15 grand was the margin for the products that they're selling. And so when those freight costs go through the roof, those businesses suddenly become unprofitable. Many other circumstances where an end market kind of fails to deliver on its initial promise, but that's one that's particularly frustrating. It's a little bit easier if the end market holds up and the major challenges that you're facing are really just about execution, because then there's a potential path forward. So it's about working with the team, because once again, we have the philosophy that the management team runs each business and we're there to support them. So you work with that team to work through whatever execution issue is in place, whether it's a good market, a good team, the wrong segment, something about the cost structure, or an enabling technology. But you can work through that. I think probably the hardest situation or most frustrating situation for someone in my position is if it's in an end market that is holding up. It's in a business where there's an execution challenge, but you're aware of the path forward, and you have a management team or senior management team member with a lot of influence who, for whatever reason, isn't interested in partnering. I mean, that's particularly frustrating. I think a lot of executives who have success in our model mix high capability, independent capability, with strong partnering behavior.
Gotcha. So say a private equity firm has been with the company for a couple of years and the company is doing financially very well. How and when will the firm decide to exit their investment?
Once again, it depends on the strategy of the firm. So you have some family office models where hold periods can be 10, 20 years, maybe even indefinitely. And it's more about buying a recurring revenue stream or a stream of dividends. For us, we have an explicit target of 5 years. And so, we go in and talking to LPs, limited partners, those are the firms or entities from whom we raise money. We're explicit with our strategy, saying we go in with the intention of working with this business and doing the best we can with it over a 5-year period. Sometimes things take off like a rocket and there's an opportunity to sell it to everyone's benefit a little bit earlier than that. Sometimes it takes a bit longer to realize the value that you want. So we might hold on to it for a little bit longer than 5 years, but the intent is 5. But once again, that's consistent with our strategy, and different firms approach it differently.
Gotcha. And on the flip side, if a company isn't doing well, are there certain signs that tell you that you need to exit the investment before it's too late?
Yeah, I mean, for us, I'm glad that that's not generally an approach that we take. We usually try to, work through the challenges that are facing the business, rather than kind of letting it wilt away, or pick your metaphor, at a sign of of struggle. But there are certain circumstances where you think about, you take stock of the existing situation, and then you say, what is it going to require to make this business a success? And evaluate whether collectively you have the financial and human capital and strategic resources to make that happen. And in some instances, you determine that it's, well, frankly, not worth it. But I'd say that those, once again, for our firm, that happens much less frequently. Much more often, we are trying to, invest further, make some tough decisions, but work with the company to get through a tough spot.
Gotcha. And in your firm's case, where you're looking for the 5-year period, at the end of the 5 years or at the end of like 5-year range, how do you guys specifically exit the investment?
So most of them are done via an auction process, managed by a bank. But is that what you want to talk about, the kind of the mechanics of an auction, or just how we make that decision? Or
Yeah, like who would you sell your stake to your firm, or how that exit specifically look like?
yeah, so that we will engage a banker or a few bankers who know the market and know the likely targets who would be interested in purchasing this business, and then they'll manage an auction process just as if you were, once again, going back to the metaphor or the analogy of private equity as residential real estate. Just if you had a real estate broker who put a house on the market and sought bids from interested parties and managed that process and played the high bidders against each other to get the best terms for his or her client. It's really much the same way.
And who are normally at these auctions? Are there just other private equity firms?
There are two sets of buyers. One is financial sponsors, i.e. other private equity firms, or there are strategics. So there are strategic firms who think that this private equity asset would be a good part of their portfolio.
Makes sense. So why would outside investors want to give money to private equity firms over hedge funds or venture capital firms?
So a couple different reasons. One is just taking a portfolio management view. It could be just from the perspective of uncorrelated returns and diversification. So if you have, a portfolio that has, pick your different asset classes, some public equities, some private equities, some dimensions of, fixed income or cash. Adding to private equity might be diversifying from your existing holdings. But then you can also evaluate a private equity investment on its standalone merits. So perhaps, the LPs or whoever are considering this investment are just looking at the risk and return profile of this asset in relation to other asset classes and think that it's attractive.
Absolutely. So shifting a little bit more to your personal experience, what is your role at your private equity firm?
Yeah, so I work on a team that we call portfolio support, and that's inherently what it is. It's to support the portfolio. I mean, you can look at my LinkedIn profile because it's kind of like a detailed description, but we're coming at it from a management consulting perspective. So working operationally with functional leads across the business, IT, HR, marketing, finance, et cetera, and supporting those executives in any way that they want us to plug in. once again, some firms have operating partners, some firms have strategic resources groups. They do similar things. It's the engagement model is slightly different. Once again, we call ours portfolio support, but I found that working with the executive teams is really fulfilling. The highest ROI on my time is around talent and working with the right set of executives to create value.
Makes sense. In the beginning, you mentioned the term leveraged buyout. So what is a leveraged buyout and how is that different than what private equity firms do?
Yeah, in my understanding, there isn't a difference. It's just a rebrand. So once again, I mean, that's how I started off of what is PE. It was, it used to be called LBO. So you just like residential real estate, you're buying an asset with some equity, and which is cash, and some debt or some leverage. So I think it's just how junk bonds were the former name for high yield bonds. It's a rebranding to make it sound a little bit better.
Makes sense. As a final question, a lot of people transition from investment banking to private equity. Do you know a little bit about how the private equity work hours differ from investment banking?
I don't, not from firsthand experience. If you look at my background, I worked at JP Morgan, but was not an investment banker, and I'm not on the deal team at my current firm. But based on what I've seen, I don't think that they're materially different in terms of hours and lifestyle. I think some people who used to be bankers are excited by the nature of the work of private equity, where, once again, I haven't been a banker, but a lot of banking is just facilitating the transaction, where in private equity, you're actually representing the entity that's taking ownership of the asset and managing it or working with that business while you own it. So it could, personally, I would find that private equity model more fulfilling, but there are people who might be attracted to the other side.
Gotcha. I want to ask one more question before we wrap this up. In general, in your experience or at your firm, what's the general path to private equity? Do most undergrad or new grads go immediately to private equity, or how do they generally come to these firms?
Yeah, and once again, different strategies for different firms, different recruiting sources. A lot of firms will hire, laterally experienced hires or people coming out of business school. The experience in my firm is there's a lot of promotion from within. And so what that means is there's a large analyst class every year that comes right out of undergrad. And then there's an associate class that maybe has a couple of years of investment banking. But there aren't that many hires added to one. I'm just talking about the deal team, the transaction team. Later on, it's very rare for someone to come in and join my firm's deal team at the vice president, principal, or managing director level. It's different when you're talking about joining a PE firm in a non-transaction role, such as myself. Then there are many different paths people can take.
All right, awesome. That sounds like a good time to wrap this event up. We appreciate everyone tuning in and want to extend a special thanks to Mr. Winterley for making this event possible.
Thank you. Thanks for having me.